the International Monetary Fund, IMF, a potted history, its makeup, its role in Ukraine and current relationship with Russia, and news of the move by the IMF in September 2024 to appoint a US-sanctioned Russian to the board of the IMF, a close connection to the indicted war criminal Vladimir Putin. This thread is not a comprehensive view and history of the IMF, it brings together key reported information and facts that will provide you with a better understanding. Please remember to like and share this post, it will help with the reach of information to a wider audience. The IMF is an United Nations (UN) specialized agency, founded at the Bretton Woods Conference in 1944 to secure international monetary cooperation, to stabilize currency exchange rates, and to expand international liquidity, access to hard currencies. The first half of the 20th century was marked by two world wars that caused enormous physical and economic destruction in Europe and a Great Depression that wrought economic devastation in both Europe and the United States. These events kindled a desire to create a new international monetary system that would stabilize currency exchange rates without backing currencies entirely with gold, to reduce the frequency and severity of balance of payments deficits, which occur when more foreign currency leaves a country than enters it, to eliminate destructive mercantilist trade policies, such as competitive devaluations and foreign exchange restrictions, all while substantially preserving each country's ability to pursue independent economic policies. Multilateral discussions led to the UN Monetary and Financial Conference in Bretton Woods, New Hampshire, US, in July 1944. Delegates representing 44 countries drafted the Articles of Agreement for a proposed international monetary fund that would supervise the new international monetary system. The framers of the new Bretton Woods monetary regime hoped to promote world trade, investment, and economic growth by maintaining convertible currencies at stable exchange rates. Countries with temporary, moderate balance of payments deficits were expected to finance the deficits by borrowing foreign currencies from the IMF rather than by imposing exchange controls, devaluations, or deflationary economic policies that could spread their economic problems to other countries. After ratification by 29 countries, the Articles of Agreement entered into force on December 27, 1945. The Fund's Board of Governors convened the following year in Savannah, Georgia, U.S., to adopt bylaws and to elect the IMF's first executive directors. The governors decided to locate the organization's permanent headquarters in Washington, D.C., where its 12 original executive directors first met in May 1946. The IMF's financial operations began the following year. Structure of the IMF. The IMF is headed by a board of governors, each of whom represents one of the organization's approximately 180 member states. The governors, who are usually their country's finance ministers or central bank directors, attend annual meetings on IMF issues. The fund's day-to-day operations are administered by an executive board, which consists of 24 executive directors who meet at least 3 times a week. 8 directors represent individual countries: China, France, Germany, Japan, Russia, Saudi Arabia, the United Kingdom, and the United States, and the other 16 represent the fund's remaining members, grouped by world regions. Because it makes most decisions by consensus, the executive board rarely conducts formal voting. The board is chaired by a managing director, who is appointed by the board for a renewable 5-year term and supervises the fund's staff of about 2,700 employees from more than 140 countries. The managing director is usually a European and, by tradition, not an American. The first female managing director, Christine Lagarde of France, was appointed in June 2011. Each member contributes a sum of money called a quota subscription. Quotas are reviewed every 5 years and are based on each country's wealth and economic performance. The richer the country, the larger its quota. The quotas form a pool of loanable funds and determine how much money each member can borrow and how much voting power it will have. For example, the United States' approximately $83 billion contribution is the most of any IMF member, accounting for approximately 17% of total quotas. Accordingly, the United States receives about 17% of the total votes on both the Board of Governors and the Executive Board. The group of 8 industrialized nations, Canada, France, Germany, Italy, Japan, Russia, the United Kingdom, and the United States, controls nearly 50% of the fund's total votes. The IMF's primary objectives: to promote exchange stability throughout the world, to promote international monetary cooperation, to facilitate the expansion and balanced growth of international trade, to assist in the establishment of a multilateral system of payments, and make resources available to members experiencing balance of payments difficulties. Publications. IMF provides periodic assessments of global prospects in its World Economic Outlook, of financial markets in its Global Financial Stability Report, of public finance developments in its Fiscal Monitor, and of external positions of the largest economies in its External Sector Report, in addition to a series of regional economic outlooks. The IMF's operation. Since its creation, the IMF's principal activities have included stabilizing currency exchange rates, financing the short-term balance of payments deficits of member countries, and providing advice and technical assistance to borrowing countries. Under the original Articles of Agreement, the IMF supervised a modified gold standard system of pegged, or stable, currency exchange rates. Each member declared a value for its currency relative to the US dollar, and in turn the US Treasury tied the dollar to gold by agreeing to buy and sell gold to other governments at $35 per ounce. A country's exchange rate could vary only 1% above or below its declared value. Seeking to eliminate competitive devaluations, the IMF permitted exchange rate movements greater than 1% only for countries in fundamental balance of payments disequilibrium, and only after consultation with, and approval by, the fund. In August 1971, U.S. President Richard Nixon ended this system of pegged exchange rates by refusing to sell gold to other governments at the stipulated price. Since then, each member has been permitted to choose the method it uses to determine its exchange rate. A free float, in which the exchange rate for a country's currency is determined by the supply and demand of that currency on the international currency markets. A managed float, in which a country's monetary officials will occasionally intervene in international currency markets to buy or sell its currency to influence short-term exchange rates. A pegged exchange arrangement, in which a country's monetary officials pledge to tie their currency's exchange rate to another currency or group of currencies. Or a fixed exchange arrangement, in which a country's currency exchange rate is tied to another currency and is unchanging. After losing its authority to regulate currency exchange rates, the IMF shifted its focus to loaning money to developing countries. The IMF's largest borrowers are Greece, Ukraine, Pakistan, and Egypt. Financing balance of payments deficits. Members with balance of payments deficits may borrow money in foreign currencies, which they must repay with interest, by purchasing with their own currencies the foreign currencies held by the IMF. Each member may immediately borrow up to 25% of its quota in this way. The amounts available for purchase are denominated in special drawing rights, SDRs, whose value is calculated daily as a weighted average of four currencies: the US dollar, the euro, the Japanese yen, and the British pound sterling. SDRs are an international reserve asset created by the IMF in 1969 to supplement members' existing reserve assets of foreign currencies and gold. Countries use the SDRs that have been allocated to them by the IMF to settle international debts. More than 20 billion SDRs were allocated to members in successive allocations from 1969 through 1981. SDRs are not part of the quota subscriptions supplied by members, and thus they are not part of the general asset pool available for loans to members. The IMF uses the SDR as its unit of account for all transactions. Drawing on the IMF by a country raises the fund's holdings of that country's currency but lowers its holdings of another country's currency by an equal amount. Thus the composition of the fund's resources changes, but the total resources as measured in SDRs remains the same. The country repays the loan over a specified period, usually 3 to 5 years, by using member currencies acceptable to the IMF to repurchase its own national currency. Has this content been useful to you? Would you like to see more research and translation content from Beefeater? If you do, and you want to stay up to date with my work, Please take a moment to like this video and subscribe to the channel now. It takes just a few seconds and it's free. This is really important. Your support and recommendations can make a big difference to the channel. Only about 20 currencies are borrowed during a typical year, with most borrowers exchanging their currency for the major convertible currencies, the US dollar, the Japanese yen, the euro, and the British pound sterling. Countries whose currencies are borrowed by other member governments receive remuneration, about 4% of the amount borrowed. Additional loans are available for members with financial difficulties that require them to borrow more than 25% of their quotas. The IMF uses an analytic framework known as financial programming, which was first fully formulated by IMF staff economist Jacques Pollack in 1957, to determine the amount of the loan and the macroeconomic adjustments and structural reforms needed to re-establish the country's balance of payments equilibrium. The IMF has several financing programs, or facilities, for providing these loans, including a standby arrangement, which makes short-term assistance available to countries experiencing temporary or cyclical balance of payments deficits. An extended fund facility, which supports medium-term relief. A supplemental reserve facility, which provides loans in cases of extraordinary short-term deficits. A poverty reduction and growth facility. Each facility has its own access limit, disbursement plan, maturity structure, and repayment schedule. The typical IMF loan, known as an upper credit tranche arrangement, features an annual access limit of 100% of a member's quota, quarterly disbursements, a 1 to 3 year maturity structure, and a 3 to 5 year repayment schedule. The IMF charges the same interest rate to every country that borrows from a particular financing facility. Loans typically carry annual interest charges of approximately 4.5%. Each of these loans is accompanied by a letter of intent that specifies the macroeconomic adjustments and structural reforms required by the IMF as conditions for assistance. Loan conditions, or conditionality, have been explicitly authorized by the Articles of Agreement since 1968. Typical conditionalities require borrowing governments to reduce budget deficits and rates of money growth, to eliminate monopolies, price controls, interest rate ceilings, and subsidies, to deregulate selected industries, particularly the banking sector, to lower tariffs and eliminate quotas, to remove export barriers, to maintain adequate international currency reserves, and to devalue their currencies if faced with fundamental balance of payments deficits. These adjustments are intended to reduce imports and increase exports to enable the country to earn sufficient foreign exchange in the future to pay its foreign debts, including the newly incurred IMF debt. Most lending programs specify quarterly targets for key economic variables that, in theory, must be met to receive the next loan installment. The IMF and Ukraine. On March 31, 2023, the IMF Executive Board approved a 4-year extended fund facility for Ukraine with funding of about $15.6 billion USD, SDR 11.6 billion. This arrangement is part of an overall support package for Ukraine from international partners worth about $122 billion USD. On the 28th of June, the Executive Board of the International Monetary Fund, IMF, completed the 4th review of the extended arrangement under the Extended Fund Facility, EFF, for Ukraine. The successful review paves the way for Ukraine to immediately receive the tranche of F financing in the amount of about $2.2 billion USD, SDR 1.66 billion. This will bring the total disbursements under the IMF-supported program to about $7.6 billion USD. The state budget of Ukraine has already received 4 tranches under the IMF-F arrangement totaling about $5.4 billion USD, including about $900 million USD in March 2024. In total, in 2024, the F provides $5.4 billion USD. Ukraine has met all the structural benchmarks for the 4th review stipulated in the Memorandum of Economic and Financial Policies. For the first time in the history of cooperation with the IMF, Ukraine has progressed so far in implementing the terms of the joint program. The successful 4th review of the F is the result of coordinated work of the Government of Ukraine, the National Bank of Ukraine, and the IMF. It underscores Ukraine's capacity to implement reforms and effective policies that ensure macroeconomic stability, and to steadily advance towards EU integration, even amid full-scale war. To date, support amounts to over $8 billion in budgetary assistance. Following the fourth review, IMF staff noted that the Ukrainian economy was more resilient than expected in the first quarter of 2024, with robust growth outturns, continued disinflation, and the maintenance of adequate reserves. At the same time, the outlook for the remainder of the year has worsened, largely due to devastating Russian attacks on Ukrainian energy infrastructure and uncertainty about the length of Russia's war against Ukraine. Next, the IMF and Russia. Russia officially joined the IMF on June 1, 1992. IMF resident representative in Russia Annette Kyobe has published papers on a wide range of topics, including gender, fiscal policy, financial development, structural reforms, macroeconomic stability and international finance. Her last report on Russia, however, tabled through the IMF, was one about the regional disparities and fiscal federalism in Russia, published in January 2022, the month before Russia's illegal invasion of Ukraine. As reported by Jeff Sonnenfeld and his team at Yale, the IMF Russia desk economists have, basically zero visibility, into what is actually going on in the Russian economy. This is at odds with IMF protocols. Since the outbreak of war, the IMF has allowed Russia to be in violation of its own membership standards, which require member states to disclose transparent, verifiable, and comprehensive national income statistics. Putin now refuses to disclose major economic indicators ranging from foreign trade data, monthly output data on oil and gas, capital inflows and outflows, financial statements of major companies, central bank monetary base data, foreign direct investment data, domestic value added by industry, and lending and loan origination data. Even Rosaviatsia, Russia's federal air transport agency, has stopped publishing data on air passenger volumes. Yet these are the major high-frequency flow statistics that go into the construction of an economy-wide GDP forecast for any nation from the US to China. Thus, the IMF simply does not have the data needed to independently calculate Russia's GDP by any accepted method, whether it's by expenditures, production, or incomes. They are flying blind, with the Russian institutions offering zero visibility. Many Western nations raised the possibility of Russia's expulsion from the IMF in the aftermath of the Ukraine invasion, but that proved difficult because of reluctance from other members with large voting quotas such as China and India. The IMF has been criticized by Western member states since the start of the war for providing what they say are overly optimistic outlooks for the sanctions-hit Russian economy, and warnings that any decisions about seizing frozen Russian assets should be backed with sufficient legal support. Nearly 3 years into Russia's genocidal invasion of Ukraine, September 2024, the IMF announces a new, sanctioned, Russian board appointment. The IMF will become the first major international financial body to send its official mission to Russia since the invasion of Ukraine in February 2022, Alexei Mozhin, the IMF's Russian executive director, told Reuters. Mozhin said the International Monetary Fund mission would start via an online format on September 16, and will continue with an IMF delegation visit to Moscow for meetings with Russian officials until October 1. The IMF's last annual mission visited Russia in November 2019, before the start of the COVID pandemic. There have been no IMF missions to Russia since the start of Russia's war in Ukraine. We were excluded from this process under pressure from our Western friends, and there were no further missions in 2022-23, Mozhin said from his IMF office in Washington. The IMF has just allowed Russia to get its claws back into the IMF by appointing a US-sanctioned Russian war criminal and Putin crony as a member of its executive board. Mozhin said he will be replaced by central banker Ksenia Yudieva, a close associate of central bank governor Elvira Nabiullina. Yudieva has been under U.S. sanctions since April 2022. She will have to run the office from Moscow initially, Mozhin said. Yudieva was sanctioned as board chairman of Okriti Bank, which the central bank used to own. The bank was sold to state lender VTB in 2022. Yudieva has since left Okriti. The IMF said it is checking the information about Yudieva's nomination. Russia's finance ministry officially confirmed Yudieva's nomination. Yudiva received a doctorate in economics from the Massachusetts Institute of Technology and did an internship at the Stockholm School of Economics. She joined the central bank together with Nabiullina in 2013 and was one of the architects of Russia's transition to a floating exchange rate. Yudiva stepped down as the first deputy governor of the central bank in August 2023 but stayed as an advisor to Nabiullina. Moshin, an IMF veteran who oversaw Russia's joining the organization in 1992 after the collapse of the Soviet Union, is stepping down from his post from November 1, although peculiarly he said he will assist the IMF mission. This is just the latest in a series of scandals plaguing the IMF. The next section deals with controversies surrounding the IMF, and in particular one of them involving yet another dictatorship member of the IMF, who have acted deceitfully and used bully tactics to get their own way in the IMF. Next, a potted history of IMF controversies. The impact of IMF loans has been widely debated. Opponents of the IMF argue that the loans enable member countries to pursue reckless domestic economic policies knowing that, if needed, the IMF will bail them out. This safety net, critics charge, delays needed reforms and creates long-term dependency. Opponents also argue that the IMF rescues international bankers who have made bad loans, thereby encouraging them to approve ever riskier international investments. IMF conditionalities have also been widely debated. Critics contend that IMF policy prescriptions provide uniform remedies that are not adequately tailored to each country's unique circumstances. These standard, austere loan conditions reduce economic growth and deepen and prolong financial crises, creating severe hardships for the poorest people in borrowing countries and strengthening local opposition to the IMF. Russia stopped reporting auditable and verified economic data in December 2022, after a decree from indicted war criminal Vladimir Putin that effectively weaponized economic data at reporting to global organizations including the IMF. The IMF and China scam. Kristalina Georgieva returned to the World Bank in 2016 after a 6-year stint at the European Commission, where she held the prestigious post of Budget Commissioner. The World Bank was familiar territory to her as she had spent 17 years there, rising to the rank of vice president at the international lender. She's highly respected in Brussels, where many officials are sympathetic about the situation she finds herself in. Politico reported on a scandal in October 2021. Kristalina Georgieva will remain International Monetary Fund boss after its board decided against giving her the axe. Speculation over the Bulgarian's future has been rife for weeks following a probe last month into allegations she tampered with data during her time as chief executive of the World Bank to improve China's global standing in the business and investment world. The scandal had threatened to overshadow celebrations at this week's IMF World Bank biannual powwow in Washington, where top finance ministers and central bankers will rubber stamp a global tax accord that 136 nations struck last week. 3 years ago, Georgieva was accused of having pressured staff at the World Bank to boost China's position in its annual Doing Business report when she was its chief executive. The influential document ranked countries according to how corporate-friendly they were. At the time, many used it to attract foreign investment. A report commissioned by the bank's ethics committee accused Georgieva of playing a key role in trying to raise China's position in 2018. It alleged that she chastised the bank's China director for mismanaging the institution's relationship with the country. Georgieva, who found out about the report at the same time as everyone else, was cleared of playing any improper role. But the scandal caused so much controversy that Doing Business was scrapped altogether. The World Bank hired an American law firm called WilmerHale to lead an inquiry into allegations its president, Jim Yong Kim, and Georgieva pressured staffers at the institution to boost China's ranking in its 2018 Doing Business report. The World Bank's leadership was on a mission at the time to raise capital from stakeholders, including China, which had complained about its 2017 ranking, pegged at 78. Senior officials from the Chinese government met with World Bank staff and Kim, and had dinner with Georgieva to advocate for an improved ranking for 2018, when China's rating was set to drop to 85. Georgieva and Kim's staff members then intervened, according to WilmerHale, to keep China's rating at 78 to ensure their capital-raising efforts wouldn't be jeopardized. The report was an annual flagship publication that examined how business-friendly countries are by scrutinizing how their rules and regulations boost, or constrain, corporate activity. The global lender scrapped the report altogether last month in response to the scandal, adding in an accompanying statement that trust in the research of the World Bank Group is vital. Georgieva has repeatedly denied the inquiry's findings, which according to her lawyer, Lanny Brewer of Covington and Burling, draw inappropriate and unsupportable inferences about her conduct and state of mind. But some questions over Georgieva's role in the scandal linger. The shine from the IMF board's announcement was taken off from its claim that the evidence presented did not conclusively demonstrate that she played an improper role. Not a full ringing endorsement, especially considering the geopolitics at play. EU capitals back Georgieva despite the damning inquiry. Two officials told Politico that EU diplomats met over the weekend to ensure such support could carry through to the executive board, where countries hold a share of votes depending on their stake in the fund. But Europe's votes wouldn't have been enough to keep Georgieva in her job without US help. That put all eyes on US President Joe Biden, whose administration is taking a firm approach to Beijing amid growing tensions over the Chinese military buildup in the South China Sea and uncertain trade relations. Senior US senators had written to Biden, calling on him and the Treasury to carry out due diligence over the World Bank scandal and ensure full accountability. While Ms. Georgieva has stated that she fundamentally disagrees with the findings and interpretations, she has not provided any evidence to dispute them, Democrat Bob Menendez and Republican James Risch wrote in their missive. It is imperative that there is immediate and full transparency and cooperation from the World Bank, the IMF, and most importantly, Ms. Georgieva. Is China hoodwinking the World Bank and IMF on cheap loans intended for developing countries in financial distress? In February 2024, the US pressured the World Bank to end loans to China, targeting the financing of the Chinese Communist Party. The World Bank provides loans to countries in deep financial trouble. In China, the CCP are currently boasting about ending poverty in China, while extending its influence and predatory loans masquerading as the Belt and Road Initiative, while benefiting from low-interest loans from the World Bank. The CCP holds positions in the World Bank and International Monetary Fund committees. U.S. House Financial Services Committee hearing on February 6, 2024. U.S. Treasury Secretary Janet Yellen said the Biden administration is actively advocating for the World Bank to end its loans to China. This stand characterizes the broader position the U.S. and other Western nations has towards the CCP. Arguably, China no longer qualifies as a developing country. No developing countries are in the position to launch their own satellites, have a nuclear weapons arsenal, or even construct high-speed rail networks. China must be seen as a developed nation and not have access to preferential loans from the World Bank or IMF. It is a global power and world's second-largest economy, and they are using these low-interest loans for nefarious purposes. Conventional wisdom suggests that China, as the world's second-largest economy with $3 trillion in foreign reserves, no longer needs to borrow from the World Bank, particularly when the question is embellished with a politically charged notion that U.S. taxpayers should not be subsidizing loans to China. The U.S. is the largest contributor to these organizations and may withdraw their support to prevent the CCP emerging as the primary beneficiary of an aid system designed for poor countries. In December 2019, the World Bank published a statement saying it would provide low-interest loans to China to June 2025, with loans ranging from $1 to $1.5 billion annually. However, there are indeed other key considerations. The fact that the US borrows from China and China borrows from the World Bank illustrates the point that seemingly well-off countries with ample foreign exchange reserves often need to borrow, and the lender may be foreign. The U.S. government borrows because it needs to finance its persistent federal budget deficits. Americans may be rich by global standards, but Washington still needs to find resources to make up for inadequate tax revenues. Such borrowing comes from both foreign and domestic sources, with China and Japan being its major foreign creditors. The U.S. Treasury manages the borrowing with the objective of securing the lowest interest rates. China, with the huge savings of its citizens and the need to invest its substantial foreign exchange reserves abroad, is quite willing to lend on these terms. China also needs to borrow to cover its budget deficits, which come primarily from the fiscal pressures facing many of its poorer provinces. China's central government borrows on their behalf both domestically and abroad. World Bank loans are attractive in this regard, since its interest rates, which are linked to rates in U.S. financial markets, are lower than the lending rates in China. While China may benefit from World Bank support, skeptics question whether the World Bank, and indirectly the U.S. government, gains anything by lending to China. Political considerations that some have raised for curtailing lending to China are precluded in the World Bank's Articles of Agreement, which explicitly prohibit the institution from interfering in a country's internal political affairs and require it to take only economic considerations into account in its decisions. China has provided tens of billions of dollars in predatory, secretive, emergency loans, at high interest rates in opaque agreements to vulnerable countries at risk of financial crises in recent years, turning Beijing into a formidable competitor of the Western-led IMF. While China may be flipping loans by borrowing from the World Bank at a low interest rate and then providing a high interest loan to a vulnerable country, China assumes a much bigger risk as these vulnerable countries are teetering on bankruptcy. China is known to use the BRI program to secure national assets and infrastructure as collateral, while ensuring BRI projects are manned by Chinese, and on default, China assumes ownership of assets and extends their commercial and military footprint across regions like Africa and South America. One might even argue the BRI loans are designed to fail with punitive interest rates so China seizes property and establishes a footprint by default. The bailouts represent a pivot from the huge infrastructure loans China has extended over nearly a decade as part of its $838 billion Belt and Road Initiative, a program that made it the world's biggest financer of public works, eclipsing the World Bank. Three of the largest recipients of China's rescue lending have been Pakistan, Sri Lanka and Argentina, which together have received $32.83 billion since 2017, according to data compiled by Aid Data, a research lab at William & Mary, a university in the U.S. The suspicion is that countries seek out the loan to avoid going to the IMF, which demands painful reform. There may be circumstances in which the gamble for redemption works, but generally, as in the Sri Lankan case, it just makes the adjustment more painful when it actually happens. China's approach often postpones the day of reckoning. When Beijing acts as an alternative lender of last resort and bails out a distressed sovereign without requiring economic policy discipline or pursuing a coordinated debt rescheduling with major creditors, it effectively kicks the can down the road and leaves it to others to solve the underlying solvency problem. A study of the individual loans provided by Chinese financial institutions since 2017 to Pakistan, a key participant in the Belt and Road Initiative, shows a drip feed of support in the form of loans from state-owned banks and SAFE, the agency that controls Beijing's $3 trillion stash of foreign exchange reserves. The terms on such loans are far from concessionary, often building in a margin of about 3% above benchmark funding costs. In addition to these loans, the People's Bank of China, the central bank, has a currency swap agreement with its Pakistan counterpart. All things considered, it is time to stop funding China with cheap loans that should be offered by the WB and IMF to undeveloped, financially distressed countries. China is allowing the CCP to benefit from these loans for nefarious and profiting reasons, while it continues to act as a belligerent and hostile world power, supporting Russia in their illegal invasion of Ukraine. The CCP is responsible for the imprisonment of over 1 million Uyghurs and the destruction of Tibetan culture and villages in its relentless expansion program across its own borders. Has this content been useful to you? Would you like to see more research and translation content from Beefeater fella? If you do, and you want to stay up to date with my work, please take a moment to like this video and subscribe to the channel now. It takes just a few seconds and it's free. This is really important. Your support and recommendations can make a big difference to the channel.
Sorry, it's DJ.